Warren, you are a big advocate of index investing and of not trying to time the market. But by your having Berkshire hold such a large amount of cash and T-bills, it seems to me you don't practice what you preach. I'm thinking that a good alternative would be for you to invest most of Berkshire's excess cash in a well-diversified index fund until you find an attractive acquisition or buy back stock. Had you done that over the past 15 years, all the time keeping the $20 billion cash cushion you want, I estimate that at the end of 2018, the company's $112 billion balance in cash, cash equivalents, and short-term investments in T-bills would have instead been worth about $155 billion. The difference between the two figures is an opportunity cost equal to more than 12% of Berkshire's current book value. What is your response to what I say? And I forgot to say, the question is from Mike Elzhar, who is with the Colony Group located in Boca Raton, Florida.
That's a perfectly decent question, and I wouldn't quarrel with the numbers. And I would say that is an alternative, for example, that my successor may wish to employ, because on balance, I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. So it has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. But it's perfectly rational observation, and certainly looking back on 10 years of a bull market, it really jumps out at you. But I would argue that if you were working smaller numbers, it would make a lot of sense. And if we're working with large numbers, it might well make sense in the future at Berkshire to operate that way. We committed $10 billion a week ago, and there are conditions under which, and they're not remote, they're not likely in any given week or month or year, but there are conditions under which we could spend $100 billion very, very quickly. And if we did, if those conditions existed, we'd be the capital very well deployed and much better than in an index fund. And so we're operating on the basis that we will get chances to deploy capital. They will come in clumps in all likelihood, and they will come when other people don't want to allocate capital. Charlie, what do you think about it?
Well, I plead guilty to being a little more conservative with the cash than other people, but I think that's all right. We could have put all the money into a lot of securities that would have done better than the S&P with 20/20 hindsight. Remember, we had all that extra cash all that period if something had come along in the way of opportunities and so on. I don't think it's a sin to be a little strong on cash when you're as big a company as we are. We don't have to. I watched Harvard use the last ounce of their cash, including all their prepaid tuition from the parents, and plunge it into the market at exactly the wrong moment and make a lot of forward commitments to private equity. And they suffered like 2 or 3 years of absolute agony. We don't want to be like Harvard.
Plus timber and a whole bunch of things.
What?
Plus timber and
Yeah. We're not going to change.
No. We do like having a lot of money to be able to operate very fast and very big, and we don't. And maybe we won't. We know we won't get those opportunities frequently. I don't think. Certainly, in the next 20 or 30 years, there'll be 2 or 3 times when it'll be raining gold, and all you have to do is go outside. But we don't know when they will happen, and we have a lot of money to commit. And I would say that if you told me I had to either carry short-term treasury bills or have index funds and just let that money be invested in American generally, I would take the index funds. But we still have hopes. And the one thing you should very definitely understand about Berkshire is that we run the business in a way that we think is consistent with serving shareholders who have virtually all of their net worth in Berkshire. I happen to be in that position myself, but I would do it that way under any circumstances. We have a lot of people who trust us, who really have disproportionate amounts of Berkshire compared to their net worth if you were to follow standard investment procedures. And we want to make money for everybody, but we want to make very, very sure that we don't lose permanently money for anybody that buys our stock somewhere around intrinsic business value to begin with. We just have an aversion to having 1 million plus shareholders, maybe as many as 2 million, and having a lot of them ever really lose money if they're willing to stay with us for a while. And we know how people behave when the world generally is upset, and they want to be with something. I think they want to be with something that they feel is like the Rock of Gibraltar, and we have a real disposition toward that group.
I want to know, is there any way that kids can develop the delayed gratification skill?
I'll take it if you want me to, Warren.
Or could.
I'll take that because I'm a specialist in delayed gratification. I've had a lot of time to delay it. And my answer is that they sort of come out of the womb with the delayed gratification thing, or they come out of the womb where they have to have everything right now. And I've never been able to change them at all. So we identify it, we don't train it in.
Charlie's had 8 children, so he's become more and more of a believer in nature versus nurture.
You'll probably find some nice old woman of about 95 out there in threadbare clothing, and she's delaying gratification right to the end and probably has 4,000 A shares. It's just these second and third generation types that are buying all the jewelry.
It's interesting if you think about, we'll take it to a broader point, but if you think of a 30-year government bond paying 3%, and you allow for, as an individual, paying some taxes on the 3% you'll receive, and you'll have the Federal Reserve Board saying that their objective is to have 2% inflation, you'll really see that delayed gratification, if you own a long government bond, is that you get to go to Disneyland and ride the same number of rides 30 years from now that you would if you did it now. The low interest rates for people who invest in fixed dollar investments really mean that you really aren't going to eat steak later on if you eat hamburgers now, which is what I used to preach to my wife and children and anybody else that would listen many years ago. So I don't necessarily think that for all families in all circumstances that saving money is necessarily the best thing to do in life. I mean, if you really tell your kids they can, whatever it may be, they never go to the movies or will never go to Disneyland or something of the sort, because if I save this money 30 years from now, we'll be able to stay a week instead of 2 days. I think there's a lot to be said for doing things that bring you and your family enjoyment rather than trying to save every dime. So I advise delayed gratification is not necessarily an unqualified course of action under all circumstances. I always believed in spending 2 or 3 cents out of every dollar I earned, saving the rest. But I've always had everything I wanted. I mean, one thing you should understand, if you aren't happy having $50,000 or $100,000, you're not going to be happy if you have 50 million or 100 million. I mean, a certain amount of money does make you feel, and those feel around you feel better, just in terms of being more secure in some cases. But loads and loads of money. I've probably known as many rich people as just about anybody, and I don't think they're happier because they get super rich. I think they are happier when they don't have to worry about money. But you don't see a correlation between happiness and money beyond a certain place. So don't go overboard on delayed gratification.
Hi, Warren. Hi, Charlie. My name is Carrie, and this is my daughter, Chloe. She's 11 weeks. It's her very first Berkshire meeting. We're from San Francisco, and we have a question on employment for you. As both a major employer and a producer of consumer goods, what do you make of the uncertain outlook for good full-time jobs with the rise of automation and temporary employment?
Well, if we'd asked that question 200 years ago, and somebody said, with the outlook for development of farm machinery and tractors and combines and so on, meaning that 90% of the people on farms were going to lose their job, it would look terrible, wouldn't it? But our economy and our people, our system, has been remarkably ingenious in achieving whatever we have now, 160 million jobs, when throughout the period ever since 1776, we've been figuring out ways to get rid of jobs. That's what capitalism does, and it produces more and more goods per person. And we never know exactly where they're going to come from. I mean, I don't know what, if you were whatever occupation. Well, if you were in the passenger train business, I mean, that was going to change. But we find ways in this economy to employ more and more people, and we've got now more people employed than ever in the history of the country, even though company after company, and particularly in heavy industry and that sort of thing, has been trying to figure out naturally how to get more productive all the time, which means turning out the same number of goods with fewer people, or turning out more goods with the same number. That is capitalism. I don't think you need to worry about American ingenuity running out. I mean, you look at people in all kinds of businesses, and they like to make money, but they really like to be inventive. They like to do things, and this economy, it works. It'll continue to work, and it'll be it's very tough in certain industries, and there will be dislocations. We won't be making as many horseshoes and that sort of thing when cars come along and all of that. But we do find ways now to employ whatever we're employing, 155, whatever it is, million people, and supporting a population of 330 million people, when we started with 4 million people, with 80% of the labor being employed on farms. So this system works, and it will continue to work. And I don't know what the next big thing will be. I do know there will be a next big thing. Charlie?
Well, we want to shift the scut work to the robots to the extent we can. That's what we've been doing, as Warren said, for 200 years. Nobody wants to go back to being a blacksmith or scooping along the street, picking up the horsemen or whatever the hell people used to do. We're glad to have that work eliminated. And a lot of this worry about the future comes from leftists who worry terribly that the people at the bottom of the economic pyramid have had a little stretch when the people at the top got ahead faster. That happened by accident because we were in so much trouble that we had to flood the world with money and drive interest rates down to zero. And of course, that drove asset prices up and helped the rich. Nobody did that because they suddenly loved the rich. It was just an accident, and it will soon pass. We want to have all this productivity improvement, and we shouldn't worry a little about the fact that one class or another is a little ahead at one stretch.
Charlie and I, we worked in a grocery store, and when people ordered a can of peas, we had ladders that we climbed up to reach the can of peas, and then we placed it in a folding box, and then we put it on a truck. And if you looked at the amount of food actually transferred between the producer and the person who consumed it and the number of people involved in the transaction, it was, I don't know whether it was 1/3 or 1/4 or 1/5 as efficient as the best way now to get food delivered to you. And
the food was worse.
And my grandfather was distressed about the fact that this particular credit and delivery kind of store would be eliminated, and it was eliminated. But society progressed.
It's coming back.
Pardon?
It's coming back.
It's coming back, but more efficiently. Yeah. Anyway, we've seen a little creative destruction, and frankly, we're glad that it freed us up to go into the investment business. It worked out better for us.